Bond prices and interest rates are inversely related. To understand this relationship, you first have to understand what a bond is and how they work, and then you have to be very clear on what an economist means when he or she refers to the interest rate. Let's start by thinking about a bond. A bond is defined by 4 factors. First, its face value. The face value is usually $1,000, and this is the amount of money that you receive if you're holding the bond on its maturity date. The second thing is its coupon rate. The coupon rate is the rate at which the bond pays you interest. If the coupon rate is 20%, then you receive 20% of the face value every year in interest payments. So, for example, a bond with a $1,000 face value and a 20% coupon rate pays you $200 a year in coupon payments. The next thing is the bond's maturity date. The bond's maturity date is written on the face of the bond, and that's the date at which you are paid the face value, as well as the final interest payment. So, for instance, if this bond matures on the 31st of March 2001, then on that date you will receive the final interest payment of $200, and you will receive the face value of $1,000. At that point, the bond is finished. So suppose you're considering making an investment, and it's March the 31st in the year 2000. If you buy this bond today, whatever price you pay for it, then 1 year from now, on the 31st of March 2001, you will receive $200, the final interest payment, plus the face value, for a total of $1,200. Now, think about the rate of return on your money. It depends completely on how much money you pay to get this bond. If you could get it for a small price, then $1,200 is going to be a huge return. But the closer the amount you pay is to $1,200, the less interest, the less profit you're making for the year that you hold this bond. To understand this inverse relationship between price and return, think of a bond as a candy bar. Now, here's how it works. A year from now, you're going to get this candy bar. That's what it means to own this bond. And this candy bar, as we've seen, is $1,200. Now, how much are you going to pay today to get this candy bar? Suppose you pay $600 to get this promise of $1,200 in a year. That means $600, what you originally pay for the bond, is your principal, how much you've invested in this opportunity. A year from now, when you get $1,200, you're going to break off $600 and call that the repayment of your original investment. The remaining $600 is your reward, your profit, and we call that interest. Calculate the interest rate by dividing the interest payment by the principal. In this case, $600 divided by 600 gives you a rate of return of 100%. On the other hand, if you pay $900 to get this candy bar, then $900 of the $1,200 repayment is just repaying your original investment. That means only $300 is profit or interest. 300 divided by 900 is an interest rate of 33.33%. Notice, as I moved the bar over, as the price of the bond went up, the interest rate got smaller. Finally, suppose you actually pay more than the face value for the bond. Suppose you pay $1,050 to get this candy bar. That means $1,050 is a repayment of your principal, and only $150 is interest, for an interest rate of about 14.25%. So I think it's very clear that as you pay more for the bond, a larger share of the money that you get counts as repayment of your principal, leaving a smaller and smaller piece of the candy bar as interest. As the price goes up, the rate of return or interest rate falls. Let's think again about the relationship between prices and interest rates. But now I want to call your attention to the different ways in which economists use the term the interest rate. One of the things that people mean when they say the interest rate is the coupon rate on the bond, in our case 20%. Another thing that they may refer to when they use the term interest rate is the actual rate of return on the bond. If you bought the bond for $900, then your interest rate, or your true rate of return, is 33.33%. Let's look at how that works in a simple demonstration. Consider the way a seesaw works. You know that famous piece of playground equipment? It's got a fulcrum here and a horizon. On the right-hand side, we're going to put prices. On the left-hand side, we're going to put interest rates. Over here, let's start by putting the face value of the bond. And let's suppose that, as is the case with most bonds, the face value is $1,000. That face value over here is going to be balanced by the coupon rate. And let's suppose that the coupon rate is equal to 20%. Now, these things are part of the definition of the bond. Because the bond is going to pay you $200 every year, that's 20% of the face value of $1,000. Now, you're probably not going to pay $1,000 for this bond. When the bond trades in the secondary market, its price will go up and down depending on people's alternative investment opportunities and depending on people's assessment of this company's creditworthiness. So, in order to represent the price of the bond in day-to-day trading, I'm going to put a teeter-totter on this seesaw and let the board move around. So, for instance, we saw in our previous calculation that if this bond is trading at a price of $1,050, the actual interest rate or rate of return on this investment is 14.25%. Notice that when the price is above the face value, the rate of interest, the true rate of return, is below the coupon rate. On the other hand, if the price of the bond were to be below the face value, say $900, as in one of our examples, the interest rate is above the coupon rate, 33.33%. Anytime the price falls, the interest rate rises. The rate of return on the bond is higher. And anytime the price rises above the face value, the rate of return on the investment drops below the coupon rate. Now, this brings me to the third way that economists sometimes use the term interest rate, to refer to the alternative investment opportunities. That is, what is your opportunity cost for buying this particular bond? What interest rate are you giving up? That is, what could you earn if you took your money to a bank or bought another bond instead? We refer to the best available return as the market interest rate. That is what you could earn on an investment of comparable risk and comparable tax treatment. Another investment that is in all other important ways identical to this particular bond. Because, see, this bond has to be competitive with the market or no one will buy it. If the market interest rate is high and this bond is only paying you 20% and people could earn 33.33% on another investment opportunity, then this bond will have to sell at a lower price in order to make it competitive with what people could earn elsewhere. That is, when the market interest rate goes up to 33.33%, the price on this bond has to drop to $900 to make this particular bond competitive with alternative investment opportunities. On the other hand, if the market interest rate goes down to 14.25%, then this bond can sell at a premium. That is, the bondholder could charge $10.50 for the bond because that way the person buying it is earning the same return that he could get somewhere else. So think of the market interest rate as that famous bully on the playground who would come and grab one end of the seesaw and just push it around while you're stuck on the other end and just decide where he wanted you to go. The market interest rate pushes the price of this bond down or pulls it up whenever the price of the bond has to adjust to be competitive with other opportunities in the market. So, bond prices and interest rates are inversely related. First of all, they're inversely related by definition. A bigger a chunk of the bond's repayment, a bigger a chunk of the bond's money counts as repayment of your original principal investment, leaves a smaller piece to be interest. So there's a mathematical necessity in this inverse relationship. The second thing is, if the market wants this bond to pay a higher interest rate, that can only be accomplished by discounting the price. And if the market wants this bond to pay a lower interest rate, that's accomplished by selling the bond at a higher or premium price. Now, the last thing we want to touch on is this notion of present value. Present value talks about the relationship between the value of money received today and the value of money received in the future. For instance, suppose you have a certain amount of money today, maybe $1,000, and you put it in the bank earning 10% interest. The value of the money 1 year from now will be the present deposit multiplied by 1, your principal, plus I, the interest rate. So if you put $1,000 in the bank today, 1 plus 10%, the interest rate, means a year from now you'll have $1,100. $1,100 is the future value of $1,000 deposited today when the interest rate is 10%. Well, what about further years in the future? The value of the money 2 years from today is going to be equal to the value of the money 1 year from today, compounding the interest one more year. That is, if you multiply 1,100 by 1 plus 10%, you'll have $1,210. That's the value of $1,000 today, 2 years from now, when the interest rate is 10%. So you could write that as 1 plus the interest rate squared, multiplied by that deposit today. To find the future value, take the amount of money you have today and multiply it by 1 plus the interest rate raised to the power of the number of years that you're interested in, whether 1, 2, or n. Now, consider the same calculations done in reverse. Divide both sides of the equation by 1 plus the interest rate, and what you're answering is, what is the value today of money that you don't expect to receive till the future? Now, why does future money have any value today? The answer is because you can borrow against it. And a year from now, when you actually get that money, you can repay your loan with interest. But because you have to leave room for interest to accumulate, the amount of money that you can borrow today is less than the amount of money you expect to receive in the future. For instance, suppose you're going to get $1,000 in the future. How much could you borrow today if you've got to repay the loan with 10% interest? The answer is, divide $1,000 by 1 plus 10%, and you'll get about $909. Borrow $909 today, and a year from now, you'll owe $1,000, just in time to repay your loan with the receipt that you get in the future. So the present value today of $1,000 that you're expecting to get a year from now, when the interest rate is 10%, that present value is $909. In general, the present value of any amount of money is going to be that amount in the future divided by 1 plus the interest rate raised to the power of the number of years you have to wait. This compounding down here in the denominator is called discounting when we're calculating present value. And this discounting takes into account the accumulation of interest between today, when you would borrow the money, and the future, when you actually receive the money and pay off the loan. So when you hear people talking about present value, think about this: the amount of money you could borrow today against an amount that you're going to receive in the future when you know what the interest rate is.